The Bank of England and the ECB hold rates, but a cut from the BOE might be closer than we thought. This is Macro Matters, and we're talking central banks. No movement across Europe this Thursday, as markets expected. Both the ECB and the Bank of England held tight, but the BOE's decision was on a knife edge, with 4 out of 9 committee members voting for a cut. That means March's meeting is now suddenly up in the air. Well, George Buckley is chief European economist at Nomura. George, why this tilt towards a move to lower?
Well, I think a number of the MPC members have said today that it's not necessarily because of the economic data, which I don't think has been that bad, actually, between the December and today's February meeting. But what it is more to do with is the fact that the bank has revised its forecasts, and it's revised them pretty significantly. If you look at the end of 2026, 27 and 28, they no longer see inflation above target at any point. It's all below target from the second half of this year, or at target. So it's a much better profile. They've taken a knife also to their economic growth forecast. They've been lowered as well. So the combination of that and the bank's view that maybe we're still above neutral, they still need to cut interest rates further, suggests there are risks that they might have to go quicker, they might have to go more than is priced in.
Do you agree with those inflation forecasts, though? Is the UK's inflation finally under control?
I think it is. And, we've had a long-held view that we think inflation is going to dip below target in the first half of this year. Now, some of that, as Catherine Mann mentioned, in today's meeting has been or is likely to be due to mechanical base effects. And she did not want to vote for a rate cut this time purely because she didn't want to make it look like voting for a rate cut, even though it's all mechanical. It's not necessarily an underlying fall. But we will see in April some of the administered price increases drop out of the annual comparison. We'll see some of the budget changes that were announced at the end of last year pulled down on inflation as well. So that combination will see a sharp decline. And the Bank of England, just a few months ago, back in November, thought that inflation was going to be almost 3% in the second quarter of this year. They now think it's just over 2%. So this is a very significant change in forecast. And if they're right, and if we're right, then we are going to see inflation come back and fall back quite significantly.
Should committee members be worrying, though, that the British economy and especially the jobs market needs some help fairly urgently?
Well, this is something that has certainly been talked about in this particular meeting. We know from a number of labour market reports now over the last year or so that things have been weakening. We've seen the unemployment rate rise by about 0.75% over the course of the last year. We've seen vacancies fall. They're not falling anymore, but they are down relative to where they were. And importantly, wage growth is responding to that. And I think responding also to the fact that inflation is actually lower as well. So people aren't trying to claim that high rate of inflation, which we'd been seeing in the past. Then they no longer need to push for higher wages. So all of that suggests the labour market is softening. And that just gives them a bit more space in order to cut interest rates.
Meanwhile, in Frankfurt, ECB policymakers seem to think they've found a neutral rate. The market's hesitant to bet on them moving anywhere this year. But Christine Lagarde sounded quite positive on Europe's growth. Do you agree?
I do, and I think it's going to be helped by the fact that Germany is spending a lot more in terms of fiscal policy expansion, and that really is going to take effect this year. The European Commission thinks there's a very big fiscal impulse coming from Germany, admittedly not from anywhere else. A lot of other countries are doing precisely the opposite of Germany. They're not loosening fiscal policy, they're tightening. But, we have Spain, which is recovering or growing very well. We have a number of European countries where growth is actually pretty decent, and also domestic demand is pretty good as well. So I think all of that points to a strengthening in growth. And you might get that growth without inflation, because if you look at Germany's spare capacity, there's a lot of it. And that means that there is ample opportunity for growth to recover in Germany without generating the usual inflationary pressures that you might associate with stronger growth and fiscal expansion.
What about the impact of choppy financial markets, though, especially the tumbling dollar against the euro? What does that mean for policy?
Well, there were a number of questions to Madame Lagarde about that today, and she was pretty emphatic that the the ECB does not target the exchange rate. However, the exchange rate does have an impact on inflation via import prices. If you have a higher exchange rate, then you should see import prices slow, and that's something which they'll be looking out for. You know, we're forecasting that by the end of the year we'll be at around 120 against the dollar, and you probably need a further move up in the currency in order to push the ECB into action, and that's one reason why we don't expect the ECB to move rates over this year or next. We think they will stand pat and keep interest rates unchanged. I think looking further ahead, there is the possibility that the cycle is over now, the rate cutting cycle is over, and they might have to raise interest rates further ahead, because there might be a lot of pressures, some of which might be generated by Germany as that spare capacity slowly erodes over time. But at the moment, I don't think there's really any need for the ECB to do anything. And as Madame Lagarde keeps saying, they're in a good place.
That was George Buckley of Nomura. Don't forget, you can watch more videos on Reuters.com.